Hey everyone, how are you doing today? As you know, Ryan Nickel sparked the idea of adding a seller financing section to my How to Get Started One Rental at a Time course. When I think seller financing, there's two ways to go. There's the area where I have zero experience, and that is the creative financing. So we've had Ryan Nickel do something. Pace Morby has agreed to add content. So we're going to let the experts do what the experts do. However, I have a lot of experience talking about seller financing. I have added somewhere between 60 and 65 units to my portfolio with seller financing. It's an easy discussion to have historically. However, with what is going on with the current administration, it is imperative that we all learn the details. Just recently, we've heard about capital gains tax potentially going up. We've heard about the threat of of 1031 exchange going away. We've heard about the elimination of stepped up basis. So if you don't learn seller financing, you are missing out. Seller financing is going to be good for you, but it is going to be great, capital letters, italics, bold for the seller. So in order to do that, I wanted to bring a CPA, somebody who's been on the channel before, somebody I trust, recommend, and that is Bob Langworthy. How you doing, sir?
I'm doing well, Michael. Thank you for that introduction. And I'm excited to talk about this topic that's more important now than ever.
Oh, absolutely. Well, just so I don't forget, I get all excited on my topics. Tell people how they can follow you, be a part of your client base, because again, you are an accountant that understands real estate, you invest in real estate, and you are helping people across the country. So how can people follow you and reach out?
Yes, I am an investor both in office space and in residential, and I love real estate. I understand real estate investors. You can find me through LinkedIn, Bob Langworthy. You can reach out through our website, which is mainbeancounters.com. That's Maine like the state. You can, I try to follow along with the comment section in the videos that I'm featured in, although I can't always catch up with all those. And you can always just reach out directly to our office at 207-729-0041.
Bob, one more time with that phone number, because maybe they didn't have their paper out. What's the phone number?
Sure, it's 207-729-0041. And we're based in Maine, but we work with investors throughout the country. And in fact, as I mentioned earlier, I've recently come to know three of your students, California, Tennessee, and Virginia.
That's awesome.
And I'm pleased to be working with them. Two of them are coaching clients, so we're meeting every 6 to 8 weeks or so, just to talk about kind of the tax side of things with their real estate investing.
That is awesome. I'm so glad to hear that. I recommend you all the time. You know, frankly, accountants, CPAs aren't all equal, especially when you add in real estate. So I'm glad that's working out. So we are going to talk about seller financing, but I think in order to do that, this is going in my course. So we're going to crawl, walk, and then run. So again, why don't we talk about why first? And again, there are kind of three things that could be changing in the real estate environment from a tax perspective. Why don't we just hit those real early? Because folks, you need to listen for these. These are buzzwords that you need to hear. And if they change, it makes seller financing even more valuable. So why don't we hit higher capital gains tax first, because that was big news this week, Bob. Obviously, real estate appreciates, right? And if you hold it more than a year, and if you hold it for decades, like I recommend, and you sell it, you're going to pay 40 to over 50% capital gains tax potentially. Is that right?
That's correct, and that's huge. That makes capital gains now taxed more highly than any other type of income.
Yeah.
And probably people have heard, well, that's only on those people making $1 million a year or more. But when you're dealing with real estate, you need to remember you could be making $50,000 a year, and then you're a mom and pop apartment building operator. You sell that, and you have a $2 million gain because you've had that property for a while, and all of a sudden you're in that category of people that make more than $1 million a year for that 1 year in which you've sold your property.
Yeah.
So we don't want people to think that just because their W-2 income is nowhere near $1 million, that this is not a tax that's going to impact them. If they're following your program, they're buying, they get up to their 4 rentals, or they go beyond that, it wouldn't be difficult to have a year where they sell a property and they're now looking at income of over $1 million.
Yeah, folks, I'm so glad you brought it up that way. Because again, if you're doing one rental at a time and you only get to 4 and you hold for 20 or 30 years, if you were to sell, I mean, pretty much any 4 properties across the country in a calendar year, you will unfortunately make that $1 million blip. And if you bought an apartment building, even a 4, you buy 2 fourplexes and you hold them for 30 years, you're going to have $1 million, right? Again, potentially, right? 30 years. Yeah. So again, everybody could be impacted by this. So that's one, pay attention. And again, we're going to tell you how to have a conversation to save you, or ultimately now the other seller, a lot of headache and a lot of tax revenue, at least spread it out over time.
Sure.
Next up is the elimination of a 1031 exchange. I mean, if that changed, that makes seller financing a huge win. Let's talk about why.
That's right. So the 1031 exchange was limited a few years back to only real estate. Previously, you could use it for vehicles, you could use it for a corporate jet, that type of thing. They limited it to just real estate. And during the election, President Biden mentioned the possibility of getting rid of the 1031 exchange. So the 1031 exchange allows you to sell one property and buy another and roll your capital gain from one to the next. So it's not exactly avoiding capital gains, it's deferring it. And there's a special process you go through in order to do that. But it's a very powerful tool. It's a tool that a lot of real estate investors, very successful ones, will use to keep deferring the capital gains and deferring that. So without that, now those real estate investors, if they were to sell, would be looking at paying this potentially 50% in capital gains by the time you add in estate tax, which a lot of us have. And that's pretty painful, which makes seller financing that much more attractive.
And again, folks, if you've read my book, you know that 1031 exchange was a critical element in going from 8 to 80 units in our journey. And we still own all of those buildings. We may have sold one. I think we own them all still. Anyways, so, and then there's one more to talk about. Again, another buzzword, it may be attacked now or later, is the stepped up basis. And why is that important?
That's another one that they've mentioned. And so when you leave property to your heirs, let's say it's fully depreciated. Let's say it's that you bought 2 fourplexes and now, they're each worth $1 million, but your basis is only, the land. So let's say your basis is 200,000 or 300,000, but they're together worth 2 million. You leave those to your heirs. Your heirs get a step up in the basis from your basis of say 300,000 to now $2 million. And your heirs could look at it and say, I don't understand why dad did this, why mom did this. I don't like it. I just want to get rid of these things. I don't want to deal with tenants. They can sell it the next day for $2 million, have 0 capital gains. If they get rid of the step up in basis and they say the same thing, I don't understand why they had these properties. I just want to sell them. Now they have a $1.7 million long-term capital gain because it's worth 2 million. The basis is 300. Now they're paying 50% tax on some of that. That's a painful day.
Yeah. So again, folks, remember, these are conversations you need to be aware of now so that you can have conversations. There are millions of mom and pop landlords who've been buying properties for decades that have a cost basis of 0. And we're going to go through some examples. So bear with us. I want you to understand the buzzwords because as Bob indicates, these changes all make seller financing more and more advantageous for the legacy owner. Okay. So thank you for that. Let's set up an example. And again, we're going to use round numbers. We're going to ignore land for this point, because that gets in people's heads and like, well, I don't know what my land is worth. So, well, if you want to talk about land and understand that, reach out to Bob. He's already given his phone number a couple of times. He's the expert. Have those discussions. So Bob, bear with me. Let me set this example up. Let's say 30 years ago, I bought a duplex for $100,000. Okay. We're going to say that today it's worth $200,000. Okay. You and I both know that depreciation schedule on residential property is 28 and a half years, I believe. 27, 28. I think it's 28 and a half, right?
It's 27 and a half.
It's 27 and a half. Darn it. Oh, whatever. It's still less than 30. So that's why I picked 30. I knew it was less than 30. Anyways, so we know that again, the cost basis is now 0, right? Because again, we've removed land from the equation. So I want to sell this property. Again, bought for 100, 30 years later, selling for 200. Let's walk through this example for people to understand what could happen, right? So, okay, folks, 30 years ago, what year it would have been? It'd only been 1991. I buy a duplex for 100 grand. Over 30 years, I work with Bob from Maine Bean Counters, and I depreciate 27 and every year I take 1/27th and a half of the property, ultimately getting to a cost basis of zero. You with me so far, Bob? I'm accurate.
Yep.
Okay.
Yep, absolutely.
So now I don't know, 75, and I want to sell it because I want to go on a safari in Africa or whatever the hell I want to do, around the world cruise. I list the property for 200 on the MLS with some local agent. I get an all cash offer, 10-day close. I'm now waiting that process, and I call Bob and I say, Bob, I'm about to sell my duplex for 200 grand. And you tell me, did you know that you are going to have a monster tax bill due? So how would that conversation go? And what would you tell me to be on the lookout for? Because I'm already counting my 200 grand.
That's
And
right.
I'm not going to end up with 200 grand, am I?
No. And this is a great example because it's simple. And so let's talk about this. There are two pieces of this that will be taxed, and that's important for everybody to know. The first is the recapture of depreciation. And this is a tax that most average Americans know nothing about, and real estate investors typically only learn about it when they sell a property they've been depreciating. So the IRS says, hey, we gave you the benefit of depreciation all those years. Now we want to recapture that depreciation and
Yeah.
tax that.
Yeah.
And that's taxed at ordinary income rates, currently up to 25%, which is a special depreciation recapture rate. And so with our example here, they've taken $100,000 of depreciation. So just to keep the math simple, let's say that's 25% of that. So they're going to owe that $25,000. In addition, so they have a $200,000 gain. So that they're selling it for 200, their basis was depreciated down to zero.
Yep.
So half of that gain is the $100,000 of depreciation they're recapturing. The other half would be a long-term capital gain. We don't know what the rest of their income picture looks like, but should we just call it 20%?
Sure.
The top capital gains rate? They probably wouldn't be in that. If they're only selling this one, they might not hit that new special rate.
We'll do another
But
example in the
20%.
special rate. Yeah, I mean 20, even if it's 25,
Sure.
right? I mean, it's still more than I was expecting to pay.
Yeah, that's right. So let's say it's the higher long-term capital gains rate, or the one we have now, which would be 20%. That's another $20,000. They've got $45,000 to pay in taxes on this. They probably have the mortgage paid off, but they're gonna end up with 155,000 in cash. So not a bad day, but it's not a $200,000 day.
Yeah. Again, and those are all taxes. Again, this is why seller financing in that environment where their cost basis is zero is interesting, because
yes.
And again, this is a simple example. If you want to go into more details, call Bob. Right?
Yep.
Just call him, right? He is the man to have these discussions with you. And again, let's just tell him your phone number one more time.
It's 207-729-0041.
All right, good. Now I feel good about keeping the example simple. If you want to go get complex, call him. All right. So how do I want to do this? So again, we're an example. It's a duplex. It's worth 200. I'm expecting to get 200 out. I'm only going to get 145. Now, again, because I'm in escrow, right? In theory, in my simple, crazy world, I could have a totally different discussion, because maybe I don't need all that cash right now, right? And oh, by the way, I've been living off the rental income, and now the rental income is going to go to zero, and that's going to feel uncomfortable because I've depended on that cash flow, right? Because my mortgage is paid off. What if there was a way that I could maintain income and spread out my tax hits or tax consequences over, say, 20 years? Is there such a thing like that? Could we do something like that?
Absolutely. And let's make it sweeter. Let's say you could get even more money.
Oh, yes. And I can get more
years.
money. Yes, exactly.
Yeah. It's a win-win-win.
Let me think.
And
Less taxes, more money, maintain income. Tell me, how can I do that, Bob?
It's the simple process of seller financing, and the benefits to the seller are great.
Yeah.
So let's say it's 20 years, and the seller wants $20,000 a year, but they're going to charge interest on this because they're financing it.
Yeah.
So let's suppose they charge, we'll keep it simple, just 5% interest.
Okay.
It's going to be zero money down. So that's the benefit to the buyer. The buyer doesn't need to come up with anything. The buyer can just pay this 21,000, right? It's the 20,000 plus the 5% interest each year. We'll keep the interest calculation simple for the purposes of this discussion. And now the seller gets their regular monthly and regular annual income, or probably monthly, however they choose to do it.
Yep.
They get that additional 5%. When the seller went to the table with our original example, they were only going to get the 200. The buyer was going to go finance this. Some bank was going to make money.
Yep.
Now the seller makes that interest. They make the money. And then the reduction in taxes is a really interesting piece of this, because with seller financing, you're selling on an installment sale basis.
Yep.
And with that, you only pay the capital gains that is due on the money you received in that year. So instead of having, in this case, $200,000 of gain to claim all in 1 year, it's $20,000 of gain to claim in 1 year. And with the 10%, 10 grand would be depreciation recapture, so they'd still have to pay that. But the other long-term capital gain piece, that 10,000, they might not owe any tax on. And that's because currently we actually have 3 long-term capital gains rates. Most people know about the 15% and the 20%, but the bottom rate is 0%. And it's 0% for people that fall into the bottom 2 income tax brackets. So with our example here, they're 75 years old, they're probably bringing in Social Security, they might not have much by way of taxable income.
Yeah.
Their income will fall into that bottom bracket, and now they could be saving potentially 20% on the sale of this property. Well, 20% on the 100 grand, the long-term capital gain, they're saving $20,000 there.
Yeah.
And they're making 5% on the property. That's 10 grand that they're making. So that's a $30,000 swing right there between the savings and long-term capital gains tax, and then the extra interest income. And then they have the security of those regular payments monthly or annually.
Yeah. So let me just, again, Bob's the expert. You want to call him and break this down, go for it. This is how I kind of break this down. And I've done it. I had these conversations dozens of times over the last 5 to 8 years, and it's always a win-win-win. Again, remember, capital gains tax going up, stepped up basis, elimination of 1031. These are all buzzwords that make this even more beneficial. But think about this example. We went from paying potentially, what was it, $45,000 in taxes 1 year lump sum hit, to now you still got to pay the depreciation recapture. That's good, but you pay a little bit every time, right? Because it's an installment loan. And oh, by the way, if you structure it right and the other income is below the median, what is the top end of 0% on cap gains? Do you know off the top of your head?
Currently, it's income in the 12% bracket. So marriage filing jointly, that would be taxable income up to 80,000, but that's after the standard deduction, which is now almost 25,000. So that's just over $100,000.
Call it 100 grand.
Yeah.
So think about what he just said. So if you can structure your pay, again, I'm the 75-year-old selling my duplex on an installment loan. And if I manage my income right, which again is a little bit every year, I could avoid legally paying capital gains. That's why this stuff's important, folks. If they get rid of stepped up basis, that's why it's important. If you get rid of 1031, that's why if the tax rate on 1031 goes up, that's important. This seller financing is going to become a hot commodity, in my opinion, for all of these reasons. Any more thoughts on this? I want to take our example and go up a notch, but I want to make sure I give you a chance to round this one out.
Well, from the buyer's side, there's a lot of flexibility with seller financing. I mean, in this example, I put forth the idea that maybe the buyer comes with no money to the table.
Yeah.
Now that's a risk, but if the seller is holding the note, Well, they still own the property.
Yeah, exactly.
Yeah, they're just
Banks do it all the time, folks.
right. That's right. Yep.
Yeah,
Yep.
it's
And
funny.
so they've got that benefit on the buyer side of the deal as well.
Yeah.
The buyer can potentially end up with less money out of pocket over the life of this as well. So there's benefits on both the buyer side and the seller side
Oh,
of
absolutely.
doing this.
And again, you can get real creative. I have actually overpaid for seller financing, right? Kind of their price, my terms. I remember the package I was working on, where I thought the buildings were worth like 800, again, just using round numbers. They wanted $1 million. Well, I'm like, you know what? If you're willing to do a financing at 2% interest, we can have that conversation, right? So again, when you understand seller financing, all the ins and outs, you truly can create a win for you, a win for the buyer, a win on a tax basis. They maintain income, folks. I can't tell you how many landlords stay landlords because they rely on the cash flow. It's hard when they have these buildings for 30 years and the cost basis is zero. Go have the conversations. Let them know, well, do you really care what comes in? Do you really want the rent and the headaches? How about you're the bank? And I just give you a mortgage payment in theory. I mean, there's just other ways they can do this. It's so beneficial.
And if I could just add real quickly, in my oversimplification here, we kept the interest calculation just a simple 5% on the payment per year. But 5%, a 20-year, $200,000 note at 5% is $117,000 of interest.
Well,
And
that doesn't
that
suck.
interest, that's a huge amount of interest, and that's where the opportunity is.
Yeah.
Because the buyer has to pay that 117 if they are getting a conventional mortgage.
Absolutely.
And the seller gets zero of that 117 if the buyer gets a conventional mortgage.
Right.
So that 117 is where the benefit is for both parties. And let's say, that the seller just wants 50,000 in interest.
Yeah.
Fantastic. They get an extra $50,000 for the sale of their property.
Yeah.
And the buyer saves whatever that comes out to be, $67,000. Thank you. That's a substantial savings for the buyer. It's a substantial increase for the seller with that capital gain spread out so that it might not be taxable. So,
again, think about what he just said. Our simple example, oversimplified on purpose. You want to get details, call Bob. What did we do? We saved them $25,000 in capital gains, potentially. We gave them an extra $117,000 in cash, right? Over 20 years. It's called interest income. We allowed them to have income every month for 20 years, which they've come to rely on. And oh, by the way, the buyer gets a better rate. No headaches, nothing down. I mean, you just need to understand the conversations, why it's good for both of you. Don't be aggressive. You have to, the seller has to be comfortable. That's where I see people fall down on seller financing deals is they come in, what's good for them, the buyer. Stop it. Education first. Run through these numbers, run through these examples, have them check with their CPA, because the beauty about being a CPA is that they all the same rules, right? If you find your own Bob Langworthy out there, they're going to tell you the same thing, right? Well, you can pay big capital gains now, or you can spread it out because it's an installment loan. The tax code is kind of black and white that way.
Yep.
Yeah. So I just wanted to take it up a notch because, again, I did a very simple example at 200 grand. If we did $2 million, right? So all we did was add a zero. That's all we did. And maybe now it's a fourplex or an eightplex or whatever it is. Mom and dad bought 30 years ago. Everything we said still plays out, except if we were to sell now, the capital gains is not 20 grand. It's potentially, when you add state, over 50 grand or 50%, sorry.
50%. Yeah.
Right. So if we bought for $1 million, sold for 2 million, just to keep the whole story going, you could pay just roughly, that's $750,000, right? Again, $1 million. Again, it would have to be, because it's now commercial, right? So now it's 33 years. So suddenly it's 35 years. It's zero basis.
Yeah, it's 39 years, but yeah,
40 years then, whatever it is. Simple examples, Bob. Simple examples.
Well, if it's residential, let's keep it simple. If it's residential, it's still 27 and a half.
Okay, so it's a
Even if it's a
fourplex.
large building. So 20, so that's a 30-year hold. Yep.
It's a 30-year-old. Okay. So you
Yeah.
bought for $1 million, you sold for $2 million. All we did was add a zero, folks, but now the pain is much, much greater. You still pay
Yes.
25% depreciation recapture. So that's 250 grand, roughly, right?
Yep.
And here's the big one. You have $1 million in capital gains. And if you sold it all in 1 year, congratulations. You're a $1 million income earner, and you get that whopping 53 or whatever the max is.
Yeah.
That's not going to be fun.
It's painful. That's a 50%, tax on that $1 million. That's 500,000. You add in the depreciation recapture of 250,000, and now you sell your $1 million property for 2 million, and you get 1.25 million.
Yeah. No, by the way, you have transaction costs and realtor costs. You basically get your $1 million back. Congratulations after 30 years.
Yeah. Yep.
Oh,
that's a painful day. And again, these are people that might not have ever had adjusted gross income of more than 100 or 200,000 on their tax return.
No, they could have made 50 grand a year, but that 1 year.
Yep.
Oh,
yep. Painful. So there's going to be, living in a state with no income tax is a consideration for some people now, but it's going to be a consideration for more people, I think, as if this goes forward. And then on the flip side, well, states will be wise to that.
Oh, yeah.
And they'll want to figure out a way to tax the capital gain on the real estate that was in their state, even if you happen to reside in Tennessee or New Hampshire or some, tax-free state. So there's going to be a lot of different ways. Real estate investors will look to work around this, and states will look to still keep some of that income.
Oh, it's coming. Yeah, folks, this is why seller financing is important. This is why I was really happy to add this to the course, How to Get Started One Rental at a Time. Again, folks, if you are looking for a CPA that understands real estate, that knows what's going on, you need to reach out to Bob Langworthy. Bob, how do you want them to do that again?
They can reach out through our website, mainbeancounters.com, or they can call the office at 207-729-0041.
Thank you. Any other thoughts as we wrap this up, why seller financing is good for the buyer and seller as we close this out?
I think we've covered it, but just to recap, the seller can make more money and pay less in taxes while having regular cash flow, which is why they liked real estate to begin with. The buyer can get more favorable terms. They can come to the table with less money. They can pay less over time. And the reasons why we're having this conversation now is with that potential increase in the capital gains rate. It's 39.6% that's being floated, but then you add in the net investment income tax on top of that is 3.8%. Then you live in a state, and there's, I think I saw this morning, it's 13 or 14 states that have a tax on long-term capital gains. You could easily hit 50%.
Oh.
And then the loss of the 1031 exchange and the loss of the step up in basis. And those are some of our key tools in real estate.
Yeah.
Now we look at seller financing, which has always made sense from a tax perspective, makes even more sense now in light of these proposed changes.
Well, Bob, thank you for partnering with me to add this to the course, How to Get Started One Rental at a Time. Seller financing has been a tool I've used for over a decade now. I do think it is going to be an even better tool going forward, folks. So understand the conversation, watch this video a couple of times, get out a piece of paper. And again, if you want to get into the business, you want to have a CPA that can do your taxes, reach out to Bob Langworthy. Thanks, buddy.
Great. Thank you, Michael. Good to see you.
Yep.